Imagine trying to power a multi-billion-dollar AI supercomputer.
Right, a massive facility.
Exactly. A facility that's running millions of complex calculations every fraction of a second.
Yeah.
Now, imagine that entire system crashing simply because, well, a thick patch of clouds passed over a solar panel.
Which is a terrifying thought for these tech giants.
Oh, absolutely. That very real fear of the dark, of an intermittent power grid is quietly making one traditional old-school natural gas driller
hmm
arguably one of the most important tech-adjacent companies in America right now.
It really is a remarkable pivot. I mean, we are seeing a complete redefinition of what a commodity producer actually does in the 21st century.
And that is exactly what we're getting into today. Welcome to our deep dive. We're taking a curated journey for you through Expand Energy Corporation's first quarter 2026 earnings release and their accompanying investor presentation.
Yeah, and there is a lot to unpack there.
There really is. Our mission today is to look way beyond the dry financial tables. We want to uncover how North America's largest natural gas producer is actively positioning itself as the foundational backbone for two massive colliding global trends.
Right, the domestic AI tech boom and the international scramble for energy security.
Exactly. Okay, let's unpack this.
Well, to really grasp the destination they are aiming for, you first have to understand the sheer massive physical scale of the company as it stands today.
Right. So Expand Energy, they trade on the NASDAQ under the ticker EXE. They are currently the largest domestic natural gas producer.
The largest.
Yeah, and the Q1 2026 production numbers are honestly hard to even visualize. They pumped out approximately 7.44 billion cubic feet equivalent per day.
Which is just an ocean of energy.
It really is. And, whenever you see the word equivalent attached to a natural gas metric like that little E in BCF, it means they aren't just pumping pure dry gas.
Right, they are also extracting valuable liquid byproducts.
Yeah, things like ethane and propane. So the industry takes the energy value of those liquids, converts it into a natural gas standard, and just lumps it all together so investors understand the total thermal energy being produced.
And to maintain that kind of daily volume, you need a vast footprint. I mean, they currently hold roughly 2 million net acres of land.
2 million, wow.
Yeah, and it's highly strategic acreage, too. It's spread across 3 major basins. You've got Northeast Appalachia, Southwest Appalachia, and the Haynesville Shale down south.
Which means they aren't dependent on a single geographic region, right?
Exactly. If there's, say, an infrastructure bottleneck in Pennsylvania, they have the Haynesville assets in Louisiana and Texas to rely on.
And this geographically diverse footprint is generating serious cash. In Q1, their net income was nearly $1.16 billion.
But the metric that really matters here is their free cash flow.
Right, which hit a record $1.7 billion for the quarter.
Yeah, and that distinction is incredibly important. Net income is basically an accounting metric. It includes paper deductions like depreciation. Sure. But free cash flow, that is the actual, tangible cash left in the bank after the company has paid all its operating expenses and capital expenditures.
Like after they've paid to keep the lights on and the drills running?
Exactly. It's the money they can actively deploy.
And their deployment strategy in Q1 was incredibly aggressive. I mean, they didn't go out and buy a fleet of private jets or anything.
No, definitely not.
They used that $1.7 billion in free cash flow to ruthlessly slash their gross debt. They paid down about $1.3 billion since the start of the year.
Which is huge.
On top of that, they returned $150 million to their shareholders through stock buybacks.
Yeah.
So by the end of March, they brought their net debt down to $2.8 billion.
Which brings us to a metric they highlight repeatedly in the presentation, and that's a peer-leading leverage ratio of roughly 0.5x.
Right. And for anyone outside the financial sector, that leverage ratio usually refers to net debt to EBITDA.
Basically, their debt compared to their core annual earnings.
Exactly. So to put it in everyday terms for you listening, if you earn $100,000 a year, having a 0.5x leverage ratio is like having a total mortgage of just $50,000.
Yeah, which is virtually unheard of for a capital-intensive industry.
Right. It's like taking the profits from a wildly successful side hustle and paying off half your 30-year mortgage in a single afternoon.
That's a great way to put it. And it creates an investment-grade balance sheet. Energy commodities are famous for these wild boom and bust cycles.
Right.
By building this fortress of a balance sheet, during what the presentation explicitly calls cycle lows, they've built a structure that can actually take a hit.
Exactly. When prices drop, over-leveraged companies just go bankrupt.
Yeah, But Expand Energy, on the other hand, is positioned to survive a downturn and actually be opportunistic. They can buy up distressed assets or aggressively buy back their own stock when it's cheap.
So we have this massive cash-generating machine with virtually no debt burden. The obvious question this raises is, well, what is the catalyst for all this production?
Right. Where is it all going?
Yeah. Why is the market going to need 7.44 billion cubic feet of gas a day, let alone more?
Well, the source material points to a fundamental structural shift in the domestic energy landscape. For the last decade, we lived in a supply push environment.
Meaning drillers figured out horizontal fracking, produced way too much gas, and effectively pushed it into a saturated market.
Exactly, which kept prices artificially suppressed. But we are now entering a demand pull era.
Meaning the market isn't just absorbing excess gas anymore. It is actively demanding it, like pulling it out of the ground.
Yes, the presentation forecasts that by 2030, power demand in Appalachia and the U.S. Gulf Coast alone will grow by 4 to 6 billion cubic feet per day.
And that pull is coming from a very specific place.
It is. It's the accelerating, insatiable power demand of artificial intelligence and broad electrification.
Right. Modern data centers don't just require a standard commercial power hookup. A single facility might require multi-gigawatt loads.
And the tech companies building them are operating on incredibly fast, accelerated timelines. They need power yesterday.
I have to challenge this premise, though.
Okay, go for it.
If you listen to the earnings calls of the hyperscalers,
Yeah.
Google, Microsoft, Amazon, their public narrative is completely focused on zero carbon emissions.
That's true.
They all have these pledges to be 100% powered by green, renewable energy like wind and solar.
Right?
So if a tech company wants to be carbon neutral, why are they pulling natural gas from Expand Energy? Why wouldn't they just build a massive multi-acre lithium-ion battery farm right next to the data center to store the solar power for when the sun goes down?
What's fascinating here is the collision between corporate ambitions and the actual physical reality of the grid.
Okay, how so?
Well, batteries are incredible technology, but right now they're primarily suited for short-duration storage. Usually you're looking at about 4 hours of backup.
Oh, just 4 hours?
Yeah. They are great for smoothing out the evening peak, like when people get home from work and turn on their ovens and air conditioners. But an AI data center is running billions of parameters continuously. It needs baseload power, 24 hours a day, 7 days a week, 365 days a year.
So a 4-hour battery backup is completely insufficient for a facility pulling a gigawatt of power.
Precisely, because if a weather system parks over a solar farm for 3 days, those batteries drain.
And the multi-billion-dollar AI cluster just shuts down.
Exactly. And in the energy sector, the solution to that is called dispatchable power.
Meaning energy you can literally dispatch to the grid on command, regardless of the weather.
Right. Until grid-scale, multi-day battery technology experiences some kind of miraculous leap forward, natural gas is the only scalable, economically viable, and dispatchable option that can backstop renewable intermittency.
I see.
Expand Energy isn't fighting the transition to renewables. They are providing the baseline stability that makes adding wind and solar to the grid possible without causing widespread blackouts.
Okay, that paints a very different picture. Expand's assets in Appalachia are basically sitting right next to these emerging, power-hungry tech hubs in the Northeast.
They are.
But the domestic AI boom is only half of the demand equation. The presentation pivots pretty heavily from the tech hubs in the Northeast down to the U.S. Gulf Coast.
Because the domestic tech industry isn't the only entity looking for reliable baseload power, we are seeing an incredible convergence of demand from the rest of the world right there at the Gulf Coast.
Yeah, the source material projects that global LNG liquefied natural gas demand will grow by more than 50% between 2025 and 2040.
That is massive.
It adds up to roughly 33 billion cubic feet per day of new global demand. And the mechanics of how we meet that demand are fascinating, honestly.
Yeah, because you can't just run a pipeline across the Pacific Ocean to Asia.
Right. You have to take this raw physical gas, that what the industry calls feed gas, pipe it down to the Gulf Coast, and literally freeze it to minus 260 degrees Fahrenheit.
And at that temperature, the gas turns into a liquid, and its volume shrinks by about 600 times.
600 times. That's wild.
It really is. And only then can you pump it onto a specialized tanker ship, send it across the ocean, and regasify it at the destination.
And the presentation estimates that just the feed gas required at the U.S. Gulf Coast to supply these LNG export terminals is going to jump 10 to 12 billion cubic feet per day by 2030.
Which is a huge structural shift.
Yeah, and a massive chunk of this is going to Asia, places like China, India, and Southeast Asia.
Right. They are heavily price sensitive, they are actively modernizing their electrical grids, and they desperately need fuel.
So Expand Energy is taking their Haynesville acreage, which is conveniently located near the Gulf, and pointing it directly at this global market.
They are, and they are doing it very strategically, too. They recently executed a 20-year sales and purchase agreement, an SPA, with Delfin FLNG Vessel 1.
Okay.
Starting in 2031, Expand will supply 1.15 million tons of LNG per year through this floating facility.
Here's where it gets really interesting. In the past, drillers would just sell their gas to a middleman at the local U.S. price.
Yeah, the standard model.
Right, and that middleman would liquefy it, put it on a ship, and sell it in Europe or Asia for a massive premium.
Exactly.
What Expand is doing with this Delfin agreement is bypassing the middleman altogether. It's like a rural farmer who realizes his local market isn't paying enough, so he finances a direct rail line from his farm straight to a Michelin star restaurant in a wealthy city.
That's exactly what it is. Expand is securing a direct line to international markets to capture that premium global pricing for themselves. It's like a superhighway toll booth.
Yeah, and they had to be ruthless to get that direct line.
Yeah.
The notes point out that they actually terminated prior SPAs with Delfin and another commodity trader, Gunvor.
Right. They paid the necessary penalties just to clear the deck and secure this new optimized 20-year path.
A 20-year commitment is massive, though. How does an international buyer trust a single driller to supply them for 2 solid decades?
Well, it comes back to that 2 million net acres we mentioned at the start.
Right.
That acreage translates to over 20 years of high-quality, proven inventory in the ground. You have to remember, the world is going through a massive reset regarding energy security right now.
Yeah, nations have recently learned the hard way what happens when you rely on politically unstable neighbors for your energy.
Exactly. Expand Energy can walk into a room with foreign buyers and offer 2 decades of proven, secure reserves. They provide stability.
That makes a lot of sense for the international buyer, but it brings up a glaring vulnerability for Expand itself.
What's that?
Well, we are talking about hypergrowth in AI data centers domestically and a 50% surge in LNG exports globally. That is an enormous amount of demand resting on this infrastructure.
Oh, for sure.
And yet, the energy market is defined by chaos. I mean, it's highly susceptible to wild price swings, extreme weather, and sudden geopolitical shocks.
Yeah.
How does a company safeguard its operations when the actual market mechanics are so volatile?
It's the most critical question in the sector right now. The source material highlights a terrifying structural flaw in the U.S. market. Over the last decade, total natural gas supply and demand both grew by over 40%. However, the physical working capacity of natural gas storage in the United States stayed completely flat.
So the volume of gas moving through the pipes increased by 40%, but the shock absorbers for the system didn't grow at all.
Precisely. Which means any slight disruption in the supply chain creates violent price spikes or crashes.
Like what we saw with the Russia-Ukraine conflict.
Right, or if a pipeline freezes or a facility like Freeport LNG unexpectedly goes offline, the gas has nowhere to go, or suddenly there isn't enough to meet demand and the price charts just go completely haywire.
We saw exactly this during Winter Storm Fern, and the investor presentation specifically highlights their performance during that freeze.
Yeah, they proved they have the physical resilience to handle weather shocks.
They delivered 98% uptime in their Appalachia operations right through the freezing temperatures.
Which is incredibly impressive. They did admit that some ice accumulation impacted their Haynesville volumes down south, but broadly speaking, the physical system held together.
But physical resilience is only half the strategy, right?
Exactly. Financial resilience is how you actually survive the price chaos. Expand manages this by hedging. The presentation notes that 66% of their projected 2026 natural gas volumes are hedged.
Meaning they have used financial contracts to lock in a guaranteed sale price for 2/3 of the gas they haven't even pulled out of the ground yet.
Yes, if the market price unexpectedly crashes to $1 tomorrow, it doesn't matter to them because they already signed a contract to sell it for $3.
It guarantees their core revenue. But what is truly unique about Expand's strategy is that they don't just use storage and hedging to hide from volatility.
No, they don't. If we connect this to the bigger picture, their integrated strategy to grow cash flow is actually designed to weaponize that volatility.
Yeah, I was reading through this section of the presentation, and it really stands out. Most businesses crave boring, predictable revenue.
Of course.
But Expand outlines a plan to actively play the market swings. How do they actually do that?
It requires a combination of massive physical assets and, well, extreme operational discipline. First, Expand utilizes roughly 5 billion cubic feet of physical Gulf Coast gas storage.
And to be clear, we aren't talking about steel tanks sitting in a field.
No, not at all. Physical storage at this scale usually involves pumping gas high pressure into massive, depleted underground salt caverns or old reservoirs.
So they have their own massive internal shock absorbers.
Right, and they combine that physical storage with what they call dynamic capacity management.
Okay, what does that mean?
It means they are incredibly flexible with their production. For example, their 2026 guidance actually bakes in planned seasonal curtailments in the second quarter.
Curtailments, meaning they're literally choking back the flow of the wells. They keep the gas pressurized in the ground.
Yes. In the spring, when the weather is mild, people turn off their heaters but haven't turned on their air conditioners yet. Demand drops and prices fall.
Makes sense.
But Expand doesn't just blindly pump gas into a cheap market. They curtail their wells, leaving it in the ground, or they pump it into that 5 billion cubic feet of salt cavern storage.
And then they just wait for the chaos.
Exactly.
They wait for a massive winter freeze in Chicago or a heat dome in Texas or a sudden spike in overseas demand.
Yeah.
When the rest of the market is panicking and prices skyrocket because the system has no shock absorbers left, Expand opens the valves on their storage and unloads their gas into the market at a massive premium.
That is the structural arbitrage they are running. They estimate that by actively managing their storage and production around these chaotic price swings, they can squeeze out an incremental $500 million in free cash flow.
$500 million.
Yeah, they're essentially turning the inherent instability of the grid into $500 million of pure profit.
So what does this all mean? When you step back and look at the whole board, this presentation is far from a standard historical receipt.
No, it's a look ahead.
Right. For you listening, it outlines the blueprint of a company that has completely evolved beyond the old drill a hole and hope for the best business model.
They are operating as a highly sophisticated logistical and financial linchpin. I mean, they have the 0.5x leverage ratio to weather any storm, the massive acreage to guarantee supply for decades, and the physical storage to turn market panic into cash flow.
They are the physical bridge making the future possible. They are backstopping the renewable-powered AI revolution here at home, while simultaneously building direct pathways to solve the energy security crisis abroad.
It is a phenomenal strategic position to be in.
But before we sign off, there's one final lingering thought we want to leave you with.
Yeah.
We spent this entire deep dive looking at how Expand Energy is securing long-term contracts. They are feeding explosive, multi-gigawatt domestic AI data centers, and they are freezing gas to send overseas to meet a 50% surge in global LNG demand.
But the molecules of natural gas in the ground are finite.
Exactly. So the question you have to ponder is this. What happens to the everyday consumer's utility bill 5 or 10 years from now?
That's the real question.
What happens when a local household, just trying to run their furnace in the winter, is suddenly bidding against trillion-dollar tech behemoths and energy-hungry foreign nations for the exact same molecules of gas?
It's going to be a very crowded market.
Expand Energy has clearly secured their future, but what is that going to cost everyone else? Something to mull over the next time you turn on the lights or ask an AI chatbot a question. Thank you for joining us as we unpack the mechanisms behind the numbers today. We'll catch you on the next deep dive.